It is time and we have a quorum. I call to order the meeting of the Bills Committee on Inland Revenue Amendments, Automatic Exchange of Information Bill 2026. This is the first meeting. Item 1. Application for late membership. From Mr. Sunny TAN. Mr. Chan has sent a letter to the committee on the 5th of May to apply for late membership. According to the House Rules 23A, in considering application for late membership, the size of membership of the Bills Committee cannot exceed the specified upper limit, that is 15. At present, we have 9 members. According to House Rules 23B, it is up to the Bills Committee to decide whether an application for late membership is granted. Now, I would like to consult members. Do we accept the late membership application from Mr. Sunny TAN? It is agreed. Thank you. Now we have 10 members in the Bills Committee and the quorum is 3. Item 2, meeting with the administration. We will now invite the government officials to come in. Before we start the discussion, I consult members whether we need to invite written submission or submission from the public by way of public hearing from members of the public. If we do, the Bills Committee will publish a notice on the LegCo's website, and the collected views will be submitted to the administration for a consolidated reply. Now, for your information, according to the LegCo background brief, the FSTB and the Inland Revenue Department has conducted a public consultation between the 9th of December 2025 and the 6th of February this year. 43 submissions have been received mainly from professional bodies, consultancy firms, and management companies. Overall speaking, the submissions are supportive of the administration's enhancements to the Common Reporting Standard framework. Some suggestions have been made concerning the implementation. The administration indicated that in drafting the bill, those views have been considered. So concerning the invitation of public submission, should we do so by way of inviting written submission? Thank you. Now concerning the legal advisor's letter, the legal advisor has sent a letter to the administration for clarification of some legal points and the drafting matters of the bill. That's paper TsyB R2 2026-03. The reply has been sent to members on the 7th of May. That's TsyB R3 2026-01. In an appropriate time, I will invite the legal advisor for a reply. Now we will discuss the contents, the policy matters of the bill. The administration has prepared a PowerPoint presentation for us. I will now invite the administration to walk us through the presentation. And members who would like to speak, you may now press the button. Upon the conclusion of the introduction, we will open the floor. Thank you. Good morning, Chairman and members. Good morning. Thank you for assisting us in vetting the Inland Revenue Amendment AEOI Bill 2026. Now, I will explain why we are amending the law, the contents of our amendments, and the implementation plan. Now, first of all, by way of background of the bill, it is to align with the OECD's, the Organization for Economic Cooperation and Development, initiative to drive the automatic exchange of information in tax matters, that's AOEI, across tax authorities of different jurisdictions to enhance international tax transparency and combat cross-border tax evasion. Now, tax information is a very useful information, especially for jurisdictions with international tax residents. It may help those jurisdictions to gain additional tax revenue. So the OECD and also the participating jurisdictions are eager to enhance the framework. Now, in Hong Kong, we have amended the Inland Revenue Ordinance back in 2016. We have aligned the common reporting standard with the OECD, and we are exchanging the information with our partnering jurisdictions. Now, we have started the first round in 2018. So far, we have conducted 8 rounds of AEOI exchanges. Now, the Common Reporting Standard, or CRS, is devised by the OECD. Now, the financial institution of reporting jurisdiction, including banks, securities firms, insurance companies, and investment funds, are required to collect information on tax residents of reportable jurisdictions, that's overseas jurisdictions. So in other words, for Hong Kong banks and insurance companies, if the accounts are created by Hong Kong residents, and these clients are not overseas tax residents, then those information would not be used for AEOI exchange. On the other hand, if a bank has accounts created by, say, American tax residents, then these banks will have to identify the tax information from these tax residents and report the important information, for example, the client's name, the residence, and also the origin country, and also the tax reference number of that tax residence in the relevant country to the OECD, and also the balance and interest made by the accounts. So these information have to be reported to the tax authority of the jurisdiction, and the tax authority will share these information with the partnering jurisdictions. So by the end of last year, there are over 120 jurisdictions which are committed to the AEOI, including the country and Hong Kong. Now, the OECD would conduct review from time to time on whether the partnering jurisdictions have fully complied with the requirements. So the last round of peer review was conducted in 2024. So the OECD has some comments on Hong Kong's implementation of AEOI regime and CRS. First of all, the OECD stated that Hong Kong should strengthen the identification of the population of RFIs, or reporting financial institution. And also for those RFIs which are not compliant with the rules, we do have penalties, but the OECD's opinion is that our penalties are relatively mild, so we need to enhance the penalties. So we have to respond by the end of June this year. As an international financial center, we need to maintain a favorable rating with the OECD's framework to show that we are a responsible and reputable international financial center. If we cannot maintain the favorable rating, then we may be deemed as uncooperative tax jurisdiction and will be subject to defensive measures. That also extends to our tax residents and Hong Kong-based enterprises. So to maintain our favorable standing in the OECD and the concessionary measures, we have to cooperate with the OECD and implement reforms. Now, for the second part, I would like to explain the proposals of the bill. There are three. First of all, concerning RFIs, we introduce a mandatory registration requirement. Now, over the past few years, we did have a registration regime, but that's reactive in nature. Now, when RFIs maintain accounts created by overseas tax residents, they will have to register with the IRD. In other words, if banks or insurance companies do not have clients who are overseas tax residents, then they do not have to register with the IRD. So our intent was to simplify the regime. However, the OECD considers our approach to be reactive, and that we cannot maintain a full register of all RFIs. So some RFIs may have omitted information. So they may not exist on our radar. So there would be a loophole. So compare with other jurisdictions. In other jurisdictions, a mandatory registration requirement is in place for RFI. So we propose to require all RFIs to register with the IRD, irrespective of whether they have any information to report or whether they have any information of overseas tax residents. If they do, this information will be submitted to the IRD. If not, then there will be a new reporting requirement. We think this is a reasonable approach. Now, considering RFIs who were not required to register before, it may be an additional burden, so we will offer guidelines to assist RFIs to register with the IRD. The second proposal is about the record-keeping requirements in due diligence conducted by RFIs. Now, all along, we require RFIs to keep sufficient records for a period of 6 years. Now, the bill proposes two amendments. First of all, on the calculation of the period of 6 years. That's the period of 6 years after the due date of the CRS return. Now, second, we are aware that some RFIs would have ceased operations at some point of time. So the OECD reminded us that even after the dissolution or cessation of the RFI's business, it doesn't mean that the RFI can destroy the information immediately. Under OECD's requirements, all tax authorities must be able to provide information or exchange information with other partners within a period of 6 times. So in order that the IRD is able to meet that requirement, we have made reference to the company's ordinance. That's for RFIs who have ceased operation. A person who has been a director of the company is imposed with the responsibility to keep the records. It is so that when a partnering tax authority asks for information within that 6 years period, even though the RFI is dissolved, we can still get the information to fulfill the requirements.
The third aspect of the amendment is stiffer penalties. We are making two kinds of changes. For the more serious cases, breaching the IRO without a reasonable excuse, such persons and companies will be committing new offenses such as breaching the registration requirements or providing incomplete or inaccurate information or a failure to inform the Commissioner of Inland Revenue. These will be new offenses, so we will incorporate these new offenses in the ordinance. Also, in response to the OECD's requirement, we are raising the level of certain penalties. The OECD said that elsewhere in other jurisdictions, they look at the gravity of the offense in settling on the penalty. Say a bank fails to report one account, or a bank may fail to report 100,000 accounts. The penalties are the same under the current legislation, and that for the OECD is not good enough because there is no proportionality in the penalty. That's why we have taken on board the comments of the OECD and the practice of other jurisdictions. The penalties will be calculated based on the number of financial accounts involved. That means there will be a basic fine, maybe $10,000 or $30,000. That's the basic fine. And then we also look at the number of financial accounts omitted in the reporting. There will be a fine based on the number of accounts involved, maybe $1,000 or $5,000 per account omitted. So that will achieve a greater deterrent effect. We're not trying to penalize the financial institutions. We simply want to create a well-developed reporting system. And the penalty is there to achieve a deterrent effect so that financial institutions follow the rules. Now, on penalties, we want to introduce an administrative penalty system as an alternative to prosecution. We know courts have their plate full. A financial institution may acknowledge responsibility. Under this new administrative penalty system, we can go for this penalty instead of prosecution. In that case, the Inland Revenue Department can issue a penalty. So that will introduce expediency. Now, on the implementation plan, last December and in February this year, we consulted the public on this topic. In January this year, the IRD and our team held 3 briefing sessions. We heard from the industry. We took on board their comments as much as we could, so we made changes to our plan. In February this year, we consulted the panel on financial affairs. Members generally supported our proposal. So that's why we are tabling this bill for the Legislative Council to consider. If possible, we would like to see the passage of this amendment by the end of June so that we can meet the requirements of the OECD. The enhancements will take effect on January 1st next year. I understand that top of mind for members is that when we approach these amendments, whether there will be implications for Hong Kong as an international financial center and whether there will be needless burden on financial institutions. I want to make one thing clear. The amendments we put forward are the minimum required by the OECD. So we don't take any extra step. We don't go we don't go above and beyond. We only do the minimum required by the OECD. For all the requirements we introduced this time, under the Common Reporting Standard, 120 jurisdictions across the globe are following the same requirement. Similar reporting and similar penalties are in place in other jurisdictions. So we're not creating extra compliance burden. For the Inland Revenue Department, it will also launch guidelines and also put information on the website to make it easier for financial institutions to register and report data. So I will pause here and we will be happy to take questions. Thank you. I now open the floor for questions on policy matters first. Let's do 5 minutes per member, question and answers inclusive. If needed, we will do a second round. Here's the lineup. Ms. Carmen Khan, Mr. Wu Yingpeng, Mr. Rock Chen, Mr. Ronick Chen, and Mr. Chen Pui-Lang. We will start with Ms. Carmen Khan. And just joining the queue, we have Mr. Sunny TAN. I have some macro issues to raise. Since 2018, 8 rounds of exchange have taken place. For our own IRD, has the IRD obtained information from the 8 rounds of automated exchange of information in tax matters? Exchange is supposed to be a two-way process, and there are now 129 reportable jurisdictions. Have we obtained information about Hong Kong from those 8 rounds of exchange? Now, my next point has to do with a point at the panel on financial affairs. The consultation was still going on when we had the panel discussion. We discussed the point where we would see information about the comments made by the industry. Now, I can see in Annex C the government's responses to industry comments. So can the government tell us about the industry concerns and how we have responded? So 2 questions for the administration. Thank you. On the AEOI, Ms. Khan is right. It's a two-way process. Let's take 2024. The IRD in Hong Kong shared data with 85 tax authorities. Meanwhile, other tax authorities also had the duty to share data with us on Hong Kong tax residents. In 2024, we obtained information on Hong Kong tax residents from 79 other jurisdictions. That information helped us determine whether the tax filings were accurate. Now, on the consultation, the Deputy Secretary can tell us more. On Ms. Khan's question, Annex C to the paper shows we received different views during the consultation period. Those questions had to do with the registration and record keeping. There were industry comments that warranted response in our legislative proposal, such as the reporting deadline. We had proposed, starting from before the 31st of January 2027, all reporting institutions had to register, but we understood that the industry needed more time. So we decided to push back the registration deadline to 31st of March 2027. That should give more time for the industry to prepare, and that's also for them to get the information ready. Now, another point has to do with record keeping. As the Permanent Secretary said, there will be a requirement when an RFI disbands, they have to let the IRD know. The directors will also have to keep the information. There were industry comments that it may be hard for these directors to keep the information given that their institution was going to disband. So we decided to allow those directors to engage third-party service providers such as solicitors and or accounting firms to keep the information for them. The law or the bill simply says that the directors simply have to keep the information. So those directors can engage service providers to keep the information for them. So that's a point from the industry. I want to stress that third-party service providers can provide the service, but the duty rests with those directors. That's to ensure the enforceability of the law. So we have gathered industry views from different channels, and we have taken steps to respond to those comments. Chairman, from these 79 jurisdictions, we got information from them. How much in tax payment have we recovered based on the information? The IRD can take the question. Based on the AEOI data we got from other jurisdictions, the IRD holistically examines the information. Now, we tax people and companies based on the place where the revenue is generated. There were cases where we recovered back duty based on the AEOI data. Can we have more details in writing after the meeting? We do not keep those figures. She's trying to understand the success of the measure. Maybe you can provide information on how successful the measures were. Maybe some information after the meeting would do. Mr. Wu Yingpeng. This bill will introduce a mandatory registration system, and that will help our IRD a better picture of all the RFIs and reportable accounts, and there will also be a new administrative penalty system that can avoid lengthy court processes that will mean greater efficiency in enforcement for the IRD. So overall, I support the bill. I do have two questions. First, so there's a principle against double punishment for the same matter. Now, if we impose administrative penalties under Section 82C, and then in subsequent investigations, we realize there are more serious conduct, say there's fraud or there are huge sums, is there a mechanism for the IRD to revoke the administrative penalty and go for prosecution instead? Now, my second question, for all these new mechanisms, the compliance cost will go up for the market. Would there be technical support for the industry? So can we have some sort of compliance checklist? Can we have some sort of guidelines or checking tools recognized by the government? The point is to lower the compliance cost for the industry. Permanent Secretary, we fully agree with Mr. Wu. We want to make it easier for the financial institutions to report data. We want to lower their compliance cost. And that means the IRD will provide more templates and guidelines, as well as advisory services. The Commissioner of Inland Revenue, Ms. Lam, can tell us more about that. And also there was a question about subsequent revelations of more serious offenses after imposing an administrative penalty. Now, on the question about the administrative penalty, first, the RFI breaches the requirements under the amended IRO. Let's say we have determined a fine, but then we later find out that this RFI has breached the requirements in more serious ways. Now, can we revoke the penalty? The answer is no, because that is something we have already assessed. But then, the provisions also say that if we have arrived at a fine, we cannot prosecute that RFI for the same matter. But then, based on the fact of the case, we'll have to look at the offense itself. Is it about the due diligence or is it about other duties? And then we can think about prosecution under other provisions. But for the same matter, we cannot prosecute the same RFI again.
The second part of the question, compliance cost and technical support. Now on compliance cost, it mainly arises from the registration requirements that would impose some compliance costs on the industry. So we will study whether we can provide some functions on the registration system to streamline the registration procedures. No follow-up questions. Next, Mr. Rockchen. Thank you, Chairman. I have three questions. Now, in this round of amendments, all RFIs, whether or not they have reportable information, have to register and report to the IRD. So that's the OECD's requirement. However, for RFI who omitted or submit false information, there is already a penalty system. So now you are including those RFIs who do not have overseas clients under the regime. Why is that necessary? Because they have not, there is no possibility for them to breach the rules since they have no overseas clients, but they are also required to report. Why? Now, second, after cessation of an entity being a RFI, they still have to keep record. So the duty is imposed on the former directors. So if records are not being kept sufficiently, then how will the director be punished? So there are different tiers of punishments, from financial penalty to 3 years imprisonment. So what if a director fails to keep proper record after the cessation of business? The third question I ask on behalf of the industry. Some RFIs would like to clarify this with the IRD. They might have clients who were former tax residents in jurisdiction A, and afterwards they have changed their status to a tax resident in jurisdiction B. So do they only have to report the information of the clients regarding jurisdiction B rather than A? 3 questions. Permanent Secretary. Thank you, Mr. Rockchen, for your 3 questions. Now, on the first question, we are now extending the scope of the framework to all RFIs. Why is that necessary? I will first reply to that, and I will defer the other 2 questions to Ms. Florence Lam. Now, the OECD is not very happy with our existing approach based on 2 considerations. First, Hong Kong is an international financial center. However, the IRD only has 2,500 RFIs registered with it, so the number is rather small. So we share the same view with Mr. Rockchen. We have more than 2,500 RFIs. However, if a financial institution do not have overseas clients, they do not have to report and register with the IRD. So that's our explanation to the OECD. But the OECD said that's not the case for other jurisdictions. Other international financial centers have more RFIs registered. So the concern is whether there are reportable financial institutions who are not registered with our tax authority. So they would be flying beneath our radar, and our checks would not be able to cover these financial institutions. So we have no excuse for that. We have to require all financial institutions to register with the IRD. Now, for those who have clients who are overseas tax residents, they will have to submit the information to the IRD annually. Now, for those who don't have any reportable information, they still have to register. We don't think that would be exceedingly burdensome for the trade. So in order to meet the requirements of the OECD, we would like to impose this minimum requirements. Assistant Commissioner, please. Thank you. Concerning the requirements to keep record for 6 years. For non-compliance, so when a company is dissolved, the former director has to keep the record for 6 years. So the penalty is the same for RFIs and other companies. They may be imposed a Tier 3 fine that is 10,000 Hong Kong dollars. So what if a client has changed his tax status? They changed their tax residency from jurisdiction A to jurisdiction B. What about that? That's about changing the place of registration. No, I mean if I have a client who used to be a tax resident in jurisdiction A, now they have changed to jurisdiction B. So after confirming the change of the tax status, as a financial institution, I only have to report the information to the tax authority of jurisdiction B. Is that right? Yes, correct. Next, Mr. Ronnie Chen. Thank you, Chairman. 3 questions. First of all, upon dissolution of a RFI, a director has the responsibility to keep the records, but they can delegate the duty to a third party. However, the director is a natural person. Now, it seems that only one natural person is required to be appointed as that liability holder, but a natural person may decease. If that's the case, how would you define the responsibility? Have you considered that scenario? Second, now it's great that you have set out all the views submitted by the trade in Annex C. And one of the concerns is that there will be a practical guideline provided by the IRD for this requirement. But I'm worried if that is sufficient. So besides putting the guidelines online, it is best to set up a hotline to answer inquiries. So will there be a hotline and a team to answer inquiries from the trade? Third, about the workflow in general. Now, by the 30th of June this year, we have to implement the enhanced requirements. So it's great if we can complete the legislative procedures by then. However, according to the paper, there will be other works, for example, system development, testing, and enhancement, and so on. So can we meet the deadline set by the OECD? And which segment is the most time-consuming for you? I will defer the question to Ms. Florence Lam. Concerning the responsibility on director after dissolution of business, we have made reference to a similar requirement under the Companies Ordinance. That is, upon dissolution of business, every director who was a director immediately before the dissolution of the company has the responsibility to keep the record. So it depends on how many directors there are. Each of them would have the liability or responsibility to keep proper record. If there is only one director and they have deceased, then no one would have to bear the responsibility. That would be quite a rare case. On the setting up of a hotline and the guidelines, now the AEOI system has been incorporated into the IRO since 2016, so we already have a dedicated team in the IRD for that. We have an email account and also we have a hotline already. So any inquiries concerning the new requirements can be directed to these channels. And also we will update the website concerning the new requirements. Now in order to, concerning the deadline set by the OECD and the work left to be done, now by June we only have to reply to the OECD concerning the legislative work. For example, will there be registration procedures in the future? The OECD has to be sure that this system will be in place after the passage of the law amendments. So we have promised the trade to enhance the registration system. So that's our own follow-up work. So the RFI will have to register with us by the 31st of March next year, the soonest. So we will try to develop and enhance the system as quickly as possible to provide a more convenient way for RFIs to register. Next, Mr. Chen Pui-Leung. Now, RFIs include insurers. So insurance companies are very diverse. There's a general insurance, life insurance, captive insurers, and so on, and reinsurers. So would you provide clear guidelines for insurers for their reference so that they know whether they would need to be registered? Second question, concerning the responsibility of directors. Now you said that when there is only one director, the scenario mentioned by Mr. Ronald Chan would occur. But usually there are more than one directors. So if the record-keeping requirement is breached, so we will take action against all directors when the requirement is breached. How would you define who is the main responsibility holder? Now, some directors are not involved in the company's management. Many of them are non-executive directors. So will the responsibility be placed on executive directors in general? That seems more reasonable. Third, about engaging a third party to keep record. If there is a third party engaged and the third party has failed to keep the records properly, so the director will still be held accountable, but I've done my best already. So will that be a defense for the director? And will you provide guidelines on how to properly keep records for companies to follow? Permanent Secretary. Thank you, Mr. Chen Pui-Leung, for your 3 questions. Now I will give a general reply and I will defer to Ms. Florence Lam. Concerning the penalty, as I said just now, we hope all RFIs can comply with the IRD's requirements to keep proper record and provide the information in a timely manner. We don't seek to punish them. It's only when there are breaches that the penalty system would be triggered. So we have designed the penalty framework prudently and carefully. We will consider any defense and reasons submitted by the company.
First, the question about insurers. There will be new enhancements in the form of requirements. Specified insurers will be covered as RFIs. But for other insurers with cash premium policies, they will also be covered. And we are willing to provide more guidelines on this. Now, on the other question, the liability of directors of companies that have dissolved, our provisions state that every director has the duty to keep the records. Now, what if a breach happens? Who's to be held liable? That would depend on the fact of each case. there may be a reasonable excuse in certain scenarios. We will look at those situations on a case-by-case basis, and then we will decide what action to take. There was a question about engaging a third party after a company dissolves. That was a question from Mr. Chen. Are there guidelines for those cases? I think he means what would be the appropriate way forward, and we can provide guidelines on that. Mr. Sunny TAN. Thank you. My first question is that from the presentation today, I heard that there are requirements from the OECD. I get it. Those requirements come from the peer review. Are these requirements made orally, or are those requirements made as a written request? In corporate audit, some remarks are made orally, and then there are also written requirements. So we follow everything when the request is in writing. So we have to be clear about what requests are made in writing and which remarks were made orally. We have to be prudent about this. Now, RFIs cover trusts. I think trusts know what to do when a company is involved, but then there are personal trusts, and they may not be able to tell how to navigate the system. So first of all, the question is, are personal trusts regulated? Those people may not be aware of the legislation, and they may fail to comply with the new requirement. Permanent Secretary. On reporting for trusts, Ms. Lam from the IRD will discuss that point. Now, on the comments made by the OECD, I can confirm that Mr. Tan is right. In 2024, there was a peer review. The OECD made those two comments. The OECD thought we could do better in coming up with a list of all reporting financial institutions. The OECD also thought that our penalties were more lenient than other jurisdictions. The OECD officially communicated those comments to us in writing. And they would like us to provide a positive response. So we are doing this at the request from the OECD, and that's a clear request. Ms. Lam. Now my colleague will take the question about trusts. Now for personal trusts, whether that personal trust falls under the RFI depends on certain factors. So what's the trustee? The trustee may be an RFI. In that case, that RFI is covered. And if it's a trust on a personal basis, that would depend on whether this person engages in business, because this will have implications for the eligibility. We look at the facts of each case to determine whether a personal trust counts as an RFI. We have to look at whether the facts meet the requirements under the law. Thank you. I have follow-up questions, but I will save my questions for the next turn. You still have a bit of time left. The question is, when I'm the person involved, I don't have the information. I don't know what to do. The IRD knows, But for the person involved, I don't know if I have to report the information. That's the key question. Are there ways for the person involved to tell what they should do? Permanent Secretary, we understand Mr. Tan's concern. We will provide a detailed written response to Mr. Tan after the meeting on reporting for trusts, because I'm just worried about inadvertent omissions in reporting. Dr. Webster, I have a few points to make. The paper says we have to respond by the 30th of June, so we're on a tight schedule. I support the bill. On this proposal, for AEOI and FSIE, I understand the OECD conducts peer reviews. Hong Kong plays a passive role. When there's a peer review, we cooperate. Can we be more proactive in the future? Maybe we can get ready sooner in future changes so that we do not simply react to a request from the OECD. We made 2 changes in response to the comments about FSIE last time. I'm from the tech sector. Many questions were raised. I also have a question that was raised by Ms. Khan. This is not just about back duty, but our tax competitiveness is a crucial part of Hong Kong's appeal. We have a low tax regime. Can we set a key performance indicator for the work? We're not trying to get as much back duty as possible, but since we have the AEOI, maybe we can consider the amount of tax payment we have recovered. If this is having a positive impact on our tax competitiveness, then maybe we can think about how we can enhance our tax competitiveness. Now, I also have a point to make about tax compliance. Maybe after the new law takes effect, we should check with the industry about their views on the compliance cost. Some industry players told me these constant changes and constant additions of requirements warranted changes to their system, so they have concerns about the compliance cost. Permanent Secretary. I thank the member for his question. We understand the industry's concerns about these constant changes and requirements. The OECD thought we could do better in our administrative framework, so they asked us to enhance our system. New developments occur all the time in international finance. New requirements also emerge in the international tax scene. What we have observed is that there will be new requirements from the OECD. Now, for reporting institutions, aside from the 4 categories, securities firms, banks, investment trusts, and insurers, the OECD has already said that with crypto assets, those crypto asset trading platforms and custodian organizations will also be covered as reporting financial institutions under the Common Reporting Standard. So soon we will have to amend the IRO again, and we will table the bill. I am making this point because we do have to react to the new requirements. We are an international financial center and we are a responsible player, so we have to do the work. I hope members can understand this. On the next point, I agree with the member. When we introduce new rules, as Dr. Said, implementing a new requirement isn't all there is to do. We have to gauge the industry's views. After a new rule is in place, we will have to look out for room for improvement in the administrative process. We will follow up on that. On the third point, on the AEOI, whether that has an impact on Hong Kong's tax competitiveness. There shouldn't be such an impact for two reasons. First, we adopt the territorial taxation principle, and this principle remains the same. When we have information on Hong Kong tax residents elsewhere, we may gain insights into omissions in tax filings from such tax residents, and we have come across such cases. Investigations led to the recovery of tax payments, but those cases are not many. Say a Hong Kong tax resident has revenue or business in the mainland, in the US or in the UK, and they generate income. Normally, we do not tax them for that revenue, so we shouldn't have too many expectations on that front. We do look at the tax information on Hong Kong tax residents elsewhere. We take a risk-based approach. I also have some questions myself. I have some similar concerns to those raised by other members. Hong Kong is an international financial center. We have to cooperate with the OECD on the common reporting standard. I understand that we have to align ourselves with global practice. But when it comes to compliance costs, we have to stay competitiveness. We have to stay competitive. Are there requirements where we go further than other tax jurisdictions? I'm also looking at the timetable. We do not have to be ahead of others in implementing the new requirements. Are there provisions where we differ from other jurisdictions? Are we only doing what is strictly necessary? Mr. Ronick Chan suggested hotlines and templates. We should not underestimate the impact on businesses affected by the new rules. They have to engage lawyers and revisit their account opening documents. Those requirements already fill volumes. New requirements are a nuisance. How can we make the requirements accessible? Can we have more support? Can we have more specific templates so that each RFI will not have to draft their own requirements? Would there be more explanation as follow-up actions for the industry? If you can answer those inquiries up front, you will be able to allay their concerns. Now, my next question has to do with something raised by Mr. Chen Pui-leung and other members. Take precious metals. How does someone tell whether they are covered? If they conduct financial business, they have futures, or they have over-the-counter trading products, and there is custodial services, they have to report the data because they count as RFIs. But then there are people in jewelry. They may be selling spot gold. They have a jewelry business. They don't have to report the data. So on who's in scope and who's not, and how far do they have to go in complying with the requirement? Clarity is needed. there has to be a way for them to ask questions to check whether they are in scope. So these are my questions.
Thank you, Chairman, for your 3 questions. Now, first of all, I can confirm that the Chairman's understanding is correct. These amendments are merely for complying with the OECD's basic and mandatory requirements imposed on us. We have not taken opportunity to impose additional requirements on the trade. Now, second, as an international financial center, to maintain our core competitiveness, we should not be overly stringent on our requirements. So in terms of the implementation timetable, we will follow the deadline set by international bodies. For example, if the OECD gives us 2 years, normally we would choose to implement the framework by the end of the 2nd year. So we do keep in mind that it is important to maintain our competitiveness as an international financial center. Now, concerning helping the trade to understand and comply with the requirements, we will study what more can be done together with the IRD. For example, we can provide more FAQs and more channels of inquiries. And we will reach out more to trade associations to alert the trade of the new requirements. Now, for RFIs which have been registered with us, the impact would be minimal. The main difference is for those financial bodies who were not required to register before. So we may conduct briefing sessions for these new registrants. And also we may upload videos to help these stakeholders understand our new requirements. So my final point on precious metals. As mentioned by Mr. Sunny TAN, and some trustees may be involved, insurers as well. So if you can make available more resources to help these parties to know whether they need to report the information, this would be able to help them. So for those who did not have the reports before, they might have breached the law inadvertently. So we will reply to inquiries through our hotlines and our emails. Thank you. So that's the first round. For the second round, we have Ms. Carmen Khan. I will give you 5 minutes. Thank you, Chairman. I very much agree with your comments. Since we have conducted the second round of peer review, as an international financial center, we must comply with the OECD with dignity. We should comply with the requirements, but we should not go above and beyond, which would hurt our tax competitiveness. So by the end of June, we will answer to the OECD so as to maintain our favorable standing. So I would support the timetable. But we must understand the worries of the trade. Now, this is an exchange system, so the traffic goes both directions. So how much information are we obtaining from others? Now, in this year's budget, the Financial Secretary mentioned that there would be an advisory group on tax strategies. So since there are so many international requirements to follow, like BEPS 2.0 and the enhanced version of AEOI. So can we take this opportunity to compare our tax competitiveness with other financial centers? Now, we hope that we can be more proactive to follow this up through this advisory group. Also, actually, this round of change is quite substantial. I mean, the mandatory registration requirements. The previous approach was quite different. So if a financial institution considers themselves to have reportable information, then they have to register. Now, after the change, all financial institutions have to register, even though there is only new reporting. So the number of FIs required to register will be much larger. But how would you know? How can you tell when you enforce the law? For some financial institutions, there are regulatory bodies. For example, for banks, there is the HAMA and SFC, and for insurers, there is the Insurance Authority. For some other bodies, there are no regulatory bodies, for example, trustees and family offices. So what guidances are we offering to the trade? 3. We are concerned about the responsibility of directors. Now, directors are allowed to engage a third party to fulfill the obligation, but the liability is still upon the director. So the work quality of the third party is at stake here. So will they have to bear any responsibility as well? These are usually lawyer firms or accountant firms. So maybe we stop at 3 questions. Permanent Secretary, thank you, Ms. Carmen Kan, for your 3 questions. So I will invite Ms. Florence Lam to answer the second and third question. On the first comment, we agree with Ms. Carmen Kan that as an international financial center, Hong Kong must ensure our competitiveness and status is maintained. So the Financial Secretary has proposed to establish an advisory group on tax strategies chaired by himself. Its work direction completely aligns with Ms. Carmen Kan's suggestion. That is to strengthen Hong Kong's competitiveness in terms of taxation policies and also to boost economic growth through competitive tax policies. So we will gauge views from the trade and professionals to achieve the objective. The direction is clear. We are not trying to study whether we need to expand our tax base and change our tax regime. The purpose is to maintain our international competitiveness and give our economy more boost. Ms. Florence Lam, please. Concerning the opinions of the OECD that there are concerns on our ability to identify RFIs. The main concern is about unregulated FIs. So besides the mandatory registration requirements, since we have received the opinions from the OECD, we have already conducted some reviews on trust. Now, trust is rather difficult to define. However, the company's registry does maintain a register of service providers for trust. So we have already sent letters to these service providers for trust to see if any of their services would fall within the definition of RFI. Now, we have been implementing the AEOI for several years already. On our website, there's already a guide for RFIs. Still, after the change, we will provide even more clear guidances to the trade. concerning the liabilities between directors and third parties. Now, the objective is to ensure that there is still someone available to implement the requirements of 6 years record keeping after cessation of business. So that's on the directors, but they can engage a third party. So the third party may fail to keep proper record. So in deciding whether a director has breached the requirements, we will consider the facts of the case comprehensively, including the relationship between the director and the third party, and also the record-keeping arrangements between them. Chairman, sorry. My question has not been answered concerning trust, family offices and funds. So she has answered about trust, but what about family office? The same applies to family offices. It depends on the structure and the operational model of the family office. In relation to AEOI, the definition of RFI is vast. Investment entity is also covered. So it depends case by case. So the ROD really needs to establish a team to answer inquiries because the coverage is so vast. Now, for family offices, they might be single-family office, and some may be license holder or non-license holder. So you need to clarify the requirements. Let's say a family office or a trust. It is managed by a natural person. Then the trust itself does not fall within the definition of RFI. However, if a trust creates an account with a bank, then as part of the due diligence process, then the trust would be asked which tax jurisdiction's information is it holding. But depending on the arrangement, the situation may differ. So please wait for the third round. I think you have pressed the button already, or the ROD can provide written supplementation after the meeting. Yes, Chairman. After the meeting concerning the definition of RFI concerning family office, trust, and emerging investment bodies, we will provide written supplementation. Next, Mr. Sunny TAN. Thank you, Chairman. I would like to follow up on Ms. Carmen Khan's questions. Now, for your reference, let's look at the principles. Now, let's say I'm a family office or a trust. If the company trust is managed by a person, not as a business, but rather for management of his own assets, then it's not a financial institution because I'm just serving my internal purpose. On the other hand, like the chairman said, if I'm a trust and I'm just dealing with my own assets, I have created a broker's account with a financial institution, then the FI has the responsibility to report my information. So my disclosure is just at the trustees level. However, if I am a RFI, then my disclosure would extend to beneficiary level. So there is a distinction. So where do we draw the line? We have to have clear guidelines on that. Now that brings me to my second question. According to the administration, it seems that the OECD's opinion is just qualitative. There are not specific goals for us to achieve. So can you tell us what the minimum standards are. For example, that's what the Singaporean government is doing. That would help us a great deal and speed up our vetting process. So we will ask whether these requirements are just the bare minimum. There's no reason for us to go above and beyond.
Permanent Secretary. The first question will be addressed by Ms. Lam. On the second question, our IRD colleague will also come to that during the clause-by-clause scrutiny. On the penalties, we have just one level of penalty, a fine at level 3 or $10,000. Why do we want to raise it to a higher level, and then we also impose a per account fine, $1,000 or $5,000 per account? These proposals are made in response to the OECD's comment. We have looked at the practice of other financial centers such as Singapore and the UK. So we have to be at the comparable level. We will not go above those levels. Now we're in the third round. Let's do 3 minutes. Ms. Carmen Khan. Thank you. I have a question about NXC, the responses to industry comments on the penalties. Item 8. There was a question from the industry on a cap. So can we have a cap on the penalties? The response from the government is that penalties based on the number of accounts involved are also in place in other jurisdictions. So can the government elaborate on this? Permanent Secretary. Thank you. Our current practice is that for a financial institution in breach of our requirements, we impose the penalties. Our current penalties are just a fine at $10,000 or $50,000. The OECD thinks that in serious cases where someone has failed to report 10 or 100,000 accounts, the penalties are the same, and they don't think that's fair. So that's why we have adopted the practice in other jurisdictions. When there's a failure to report the data, we look at the number of accounts involved in deciding on the penalties, and that's why we propose a new penalty based on the number of financial accounts involved. There's no cap on such penalties in other jurisdictions. So we do not propose a cap on this penalty given the absence of such caps elsewhere. So what other countries have we looked at? The IRD will take the question. Now, on compliance with the due diligence requirements, we have looked at the experience of Canada, Singapore, and the UK. In the UK, they used to impose just a fixed penalty, but recently they amended their law. They do not adopt a per-account basis. They adopt a per-account holder basis. The penalties there are similar to what we propose. For breach of the due diligence requirements, we adopt $1,000 per account. In the UK, it is £100 per account holder. So that's close to our level. In Canada and in Singapore, they levy a penalty for every day of non-compliance, and they don't have a cap on in those places. Is that correct? That's true. If there are no further questions, so we have covered the policy discussion. We can move on to the clause-by-clause scrutiny of the bill. Members can refer to the blue bill. That's TsyB bracket 2394/2026. Members can also refer to the marked up copy prepared by the Legal Service Division. That's LC number TsyB bracket 342/2026 bracket 1. Can we invite the administration to take us through each clause, please? Ms. Lam from the IRD will take us through the clauses. I will read out the long title. Members can refer to page C116 for the Chinese version in the blue bill. We're amending this ordinance to strengthen the administrative framework for automatic exchange of information in tax matters in Hong Kong to ensure effective implementation of the common reporting standard developed by the Organization for Economic Cooperation and Development, and to provide for related and textual amendments. We move on to Clause 1. The short title and the commencement date. This ordinance may be cited as the Inland Revenue Amendment Automatic Exchange of Information Ordinance 2026. If enacted, this ordinance will come into operation on the 1st of January 2027. Clause 2. The Inland Revenue Ordinance is amended as set out in sections 3 to 18. Clause 3. We will now move on to the marked up copy, so please refer to page 0001. So we're making a textual amendment under section 50A, which is the interpretation. We are removing a note, but we are incorporating that text in the definition. We want to achieve greater clarity, so we're not making change to the substance of the definition. Clause 4, section 50AB, a new section. This is the mandatory registration requirement. A reporting financial institution must register in the form specified by the Commissioner of Inland Revenue on or before the following date, whichever is later, the 31st of March 2027, and this will apply to pre-existing RFIs. As for 50ABC2, the 31st of January of the year following the calendar year, in which the financial institution first becomes a reporting financial institution. So that's the registration deadline. Can we pause here? Ms. Carmen Khan has questions. I'm reading clauses 3 and 4 together in the blue bill. Or page 0001 in the marked up copy, a note is removed. That note refers to subsection 15. The administration explained that we are incorporating the note under reporting FI. Can the officials point us to the spot? In the marked up copy, we can see the sign at A within the meaning of subsection 15. The IRO defines a financial institution in Hong Kong. So that answers the question raised by members. So we already have subsection 15. It sets out what counts as an RFI. So can we look at this subsection 15? Subsection 15 is not part of the blue bill, but the provision is clear. For a Hong Kong company registered or incorporated in Hong Kong, or if it wasn't incorporated in Hong Kong, but the control and the management is exercised in Hong Kong, that counts as an FI in Hong Kong. We will need more details. If I got Ms. Khan's question correctly, we want a detailed definition of what's in scope and what's not. Further explanation of this point will address the questions raised by members. Under the IRO, there's a clear definition for FIs and RFIs, but we're not making changes to those definitions. That's why you do not see those changes in the Blue Bill. Chairman, that's the very reason that I'm seeking an explanation. So, what institutions are covered under the IRO? In the past, the definition is less of an issue because only FIs with those accounts have to report the data, but that is not good enough for the OECD. Now, all FIs will have to report the data. So it doesn't matter whether the FI has those accounts from accounts. So we have to figure out what a reporting financial institution means. Can we look at subsection 15? A reporting financial institution. Whether an FI is an RFI hinges on an FI in Hong Kong. So what do we mean by an FI resident in Hong Kong? If it's a company incorporated in Hong Kong, that counts. If it is not incorporated in Hong Kong, but the control and management happens in Hong Kong, that company also counts as a reporting FI. If it is a trust incorporated under Hong Kong laws will be treated as an RFI. But if the incorporation happens elsewhere, then we will look at whether this trust is ordinarily managed and controlled in Hong Kong. So we are going a bit beyond the scope of the bill. But this is a related point. Many questions also turn on this critical point. Can we have further papers after the meeting on this point, or do you have information at hand that you can share with us? Other follow-up questions from Ms. Carmen Khan. Can the Department of Justice help out here? Here, the change refers to the definition of financial institutions elsewhere in the ordinance. Let's take trusts. It doesn't say that personal trusts are out of scope. If we look at subsection 15, we can see that if the trustee is an individual, you do a certain thing. If it's a company, certain actions are taken. And what we do when the trustee is an entity rather than a person. We should be clear which institution will have to report the data. Are we expecting a surge in the number of institutions? In the past, only institutions with accounts have to report the data, but in the future, all financial institutions will have to file a report. Some FIs may not have regulators. We're less worried about FIs subject to a regulator. Even with trusts, you have a register where you can check. But here, with these new rules, family offices and funds may be regulated. And these FIs will have to hire advisors. They may have to. So that means solicitors and accountants have to be clear on the rules. If you have a guideline, can you share the guideline with us?
So just now, the government has promised us to provide us with supplementary documents after the meeting. So this is not the main discussion today. So I hope the government, the administration, can provide us with more clarification on the definition of the financial institutions. Mr. Sunny TAN. Thank you, Chairman. I'm concerned about the same thing. The way it is drafted Now you refer to subsection 15 for the definition. So that's very rigid. So are all institutions in subsection 15 covered? So I think it's more convenient to list out all the RFIs required to register. That would answer a lot of our questions. For example, a personal trust or the situation where a trustee is an individual. Now, trust under the name of an individual, that's one. So what about other trusts? So I think we can discuss that down the road and we can move on for now. Permanent Secretary, I thank Ms. Carmen Khan and Ms. Sunny TAN for their concerns. So let me clarify one thing here. The definition of RFIs contain 4 categories in subsection 15. So we have not changed the 4 categories of financial institution through the bill. So we have just been moving the definition around. We are referring to 51A and refer the readers to subsection 15 for the definitions. Concerning the substance of the law, there is no addition or deletion, but we have heard members' views. Concerning the situation of trust in particular, there are only 4 categories of financial institution under the law, but we will see how we can provide more information by way of administrative guidelines or in other manner. So in short, the definition of financial institution has not changed. Now we heard very clearly the definition of RFIs have not changed. What's changed is the requirements of the OECD. RFIs which do not hold overseas accounts should also register. Now, since we are expanding the scope and there is penalty in place, the implication may be far-reaching, so I would like to have more supplementary information afterwards. Ms. Carmen Khan. Chairman, my apologies. I beg to differ concerning this point. May I seek the legal advisor's assistance? Now you are deleting the note. The original note says see also subsection 15. So the note is repealed. So after repealing the note, now subsection 17 says that a note located in the text of this section is provided for information only and has no legislative effect. So you said refer to the note. So the significance is much less than including subsection 15's definition in the law. The note has no legislative effect. So subsection 15 says that all financial institutions located in Hong Kong are RFI. Legal advisor, anything to add? Thank you, Chairman. Now, subsection 15 referred to by Ms. Carmen Khan refers to what financial institutions are deemed to be a residence in Hong Kong. It's not the definition of FI, strictly speaking. DOJ, Mr. Alan Zhong. Thank you. Now, subsection 15 is the detailed explanation of what does it mean to be AFI residing in Hong Kong. So that's explained by subsection 15. So to make it more easy to understand, we refer to subsection 15 for the term residence. So although note has no legislative effect, according to the OECD, we need to explain the meaning of residence in Hong Kong. So we decided to refer to the explanation of residence for the public sake. So my understanding is correct. The note has no legislative effect, but you're asking us to refer to the note to find out what residence in Hong Kong means. But now you are including this explanation as part of the law, so we have to make a distinction between the two. Something has changed. Allow me to clarify. Subsection 15, it does have legislative effect. Now, however, the note is like a marker directing the reader to subsection 15 for the explanation of residence in Hong Kong. So the legislative effect is the same. So let's continue. Let's pick up from 50B. We're now at clause 5, page 2 of the markup copy. We are amending the existing section 50B 1A3. So this is in relation to due diligence obligations, evidence and record maintained by the financial institutions. Now we are amending the rule to 6 years upon the due date of the CRS. B, if there is any return required to be furnished, then the period would be the period mentioned in section 50D2, and that's 6 years after the due date of furnishing of return. Let's continue. Clause 6 of the bill, page 4 of the markup copy. Now that's about the obligations of reporting financial institutions in relation to returns. So subsection 1, we are changing the period of 6 years beginning on the date on which the return is furnished to 6 years immediately after the date by which the return is required to be furnished. Now we are deleting the 2ABC. Now the original 2A says the first occasion on which it commences to maintain a reportable account. Now with the registration requirements, that is moot. So we are adding under 50D subsections 2 to 10. So 50D2 refers to the period of 6 years. Subsection 3, if a reporting financial institution changes its address, it must notify the Commissioner of its new address within 1 month. Subsection 4, if an entity ceases to be a reporting financial institution, it must give a notice of the cessation to the Commissioner within 1 month. Subsection 5, if, subsequent to the cessation, the entity again becomes a reporting financial institution, Within 1 month after its again becoming a reporting financial institution, the entity must give a notice of the change of address to the Commissioner. Subsection 6. If an entity is no longer a reporting financial institution and that a notice has been given to the Commissioner, then if the entity changes its address, it must notify the Commissioner within 1 month. And even if it is no longer a RFI, it still has to comply with the subsection 1's requirement, that is, keeping record for 6 years. Subsection 7, concerning the notification requirements above, the notices must be in the form of an electronic record, that is, designated through a system designated by the Commissioner. Subsection 8. If an entity is dissolved, then during the 6 years before the dissolution, if it has been a reporting financial institution, then every person who was a director of, or if there was no director, every person who was a trustee of or who was responsible for the management of the entity immediately before the dissolution must give a notice of the dissolution to the Commissioner within 1 month and ensure that the requirement to keep record is complied with despite the dissolution. Subsection 9. The specified officers mentioned above, that is, the former directors and so on, if their contact details have changed, then they must notify the Commissioner within 1 month. Lastly, subsection 10, for the purposes of subsection 8A, that is, for the specified officers to notify the Commissioner of the dissolution of the entity, then if a notice is given by any of the specified officers, then it is regarded that the notice has been given by every specified officer. Clause subsection 11. Now let's complete subsection 11 and 12 and then move on to clause 7. Subsection 11. An assessor may give a notice to a RFI or an entity that was a RFI or a specified officer, requiring them to provide any information. Subsection 12. If a notice is given, then the RFI entity or specified officer must comply with the notice in the form specified in the notice. So let's pause here. Ms. Carmen Can, question on clause 6. Chairman, 50AB all through 50B is in relation to requiring all RFIs to register. That would add to the workload of the IRD and all RFIs. At the beginning of 50AB, you says from now on, reporting will have to be made through electronic means. So after the rules take effect, are we ready? Now, at another panel, you have mentioned that the IRD would seek funding to upgrade your system. So are we ready for accepting electronic reports? There will be hundreds of thousands of reports in the future. Now, about the calculation of the period of 6 years. The starting date has changed. Can you give us an example on when the period should start? Now, about consultation, back to the brief Annex C, the trade says that it would be quite troublesome. Now, the government said that to alleviate the compliance burden, reporting is no longer required when an entity begins, continues, or again become entity.
Ms. Lam, First, on the registration. All reporting financial institutions looking to register with the IRD use the AEOI portal. We want to enhance this portal to make life easier for RFIs in the future. We're doing it electronically now. The registration will also happen electronically in the future. Now, on the 6-year record-keeping requirement, you can find that on page 0002. Let's say an RFI has submitted the statement or the returns. Now the clock starts when the submission is done, 6 years from that point. But there is a problem. There's a shortcoming with the current practice. Let's say an RFI fails to submit the return. So the 6-year record-keeping rule will not apply. That's why we are amending the provision. The clock starts at the point when the return falls due, 6 years from that point. So normally what happens is that the information is gathered on a calendar year basis for the 2024 calendar year as a starting point. And then on the 1st of January 2025, the IRD asks RFIs to submit the information. So in the future, it doesn't matter whether an RFI submitted the return. The clock for them to keep the records will start at the deadline for the submission of the return. I also have a question myself. So you're saying that now the clock starts when the return is submitted, but there's a loophole for someone or an RFI that fails to submit the return. There's a loophole, but I think there should be legal consequences for the failure to submit the return. So now we're changing the requirement. The clock starts at the deadline for the submission. So that's the technical amendment. Follow-up question from Ms. Carmen Khan. Do we have an example? In our reply to the questions from the Legal Service Division, we explained through an example. Can you take us through that example? You cannot assume the public has read the papers. Let's look at paragraph 5 of our reply. Paragraph 5 has this to say. Now, once an FI is done with the due diligence, the FI will have to keep the records for at least 5 years after the calendar year in which the work is done. But in some cases, there may be a gap. That's why we propose to amend the provisions. If Ms. Khan is looking for further supplementary details, we can provide those after the meeting. If she wants more examples to illustrate the point. If you don't have the information at hand, you can provide the details after the meeting. I just cited an example involving the calendar year. So I've discussed how we determine the 6-year rule in the past and how the new rule will work in the future. Any follow-up from Ms. Carmen Khan? So she's referring us to the paper. So she cannot illustrate the point with an example. The OECD's requirement is that an RFI that has completed due diligence will have to keep the records for 5 years. We are amending our IRO to address this point. The existing rule may create a gap. So here's an example. An RFI completed due diligence in February 2020. The records will have to be kept up to February 2026. But if the due diligence is completed in February 2020, the reporting period should be January to December. So in January 2021, the IRD sends the returns to the RFI. So the deadline should be in June 2021 for the submission of the return. Under our new rules, the clock does not start in February 2020. Instead, the clock will start in June 2021. That means the record-keeping period will be longer, but that's to respond to the comments from the OECD about record-keeping. And my third question went unanswered. Can you repeat your third question? Because we dived deep into the second question. On the third question, I refer the member to page 0004. 50D, 2ABC. Those are the existing rules. Under those circumstances, an RFI will have to let the IRD know. First, the first occasion on which it commences to maintain a reportable account, or B, 1 year has elapsed after it ceased to maintain even a single reportable account. And if this RFI maintains such an account again, they will have to let the IRD know. But since we are requiring all RFIs to register, so we're removing this provision. Got it. The legal advisor has something to add. I want to look at Section 50D in the marked up copy. That's on pages 4 and 6 of the marked up copy. When the LSC wrote to the administration, we asked about Section 50D. Subsection 6A. When the entity changes its address, they have to let the commissioner know in a month. Subsection 9, when there's a change in the specified officer's contact details, they have to let the commissioner know in a month. And then Section 11, an assessor can give a notice to the RFI or a specified officer. Those will have to be done But subsection 11 does not come with a deadline, so we asked the administration about the legislative intent about this arrangement. The government's replies is set out in paragraphs 8 and 9. Members can refer to those paragraphs. Maybe the administration can take this opportunity to explain how this works. Now, paragraphs 8 to 10. Now let's look at Section 50D, subsection 6A, change of address. Subsection 9, change in the specified officer's contact details. In such cases, they have to let the IRD know in a month. The intent about this requirement is that we want to make sure the IRD can access their records when needed. The record-keeping requirement will go on for 6 years. So any change of address should be communicated to the IRD during the 6-year period, and we will put out guidelines on our website. We will move on with the clause-by-clause scrutiny. Please continue. Clause 7. This clause proposes to amend the existing Section 50E. We're adding the registration requirement under Section 50AB. First, I want to talk about the effect of Section 50E. This applies to RFIs that are not corporations. When they have to perform due diligence or submit returns, a representative organization will do the work. We are amending this section because of this new requirement to register. So this is a consequential amendment. We move on to Clause 8 of the bill. We propose to amend the provision about engaging service providers. An RFI can engage service providers to perform certain tasks on their behalf. We propose inserting Section 50AB bracket 1. This means RFIs can hire service providers to perform the registration. And then subsection 2, we will also add 50AB bracket 1. Subsection 2 is an existing provision. Even if a service provider has been engaged, the RFI is not relieved from its obligation under the IRO. Sorry, I have to pause here. We're approaching the scheduled end time. I will extend the meeting for 15 minutes if we're all good with that. We still have quite a lot of ground to cover. We will probably need a second meeting, but I will extend the meeting for 15 minutes so that the government can cover more provisions at this meeting. Mr. Champula, Chairman. There's only that much we can do for an extra 15 minutes. Why don't we save the discussion for the next meeting if we need a second meeting anyway? Any objections? I think we have to be mindful of the deadline at 12:45. Dr. Junius Ho, since we will need an extra meeting anyway, why don't we save the discussion for next time? I also have a comment. I have been following the discussion. The bill does not appear to be complex, but at the operational level, many stakeholders will be affected. I hope the government can prepare questions and answers for this bill. Why are we amending the law? What scenarios are we targeting? Who will be affected? What do we do to meet the requirements? Who can help? Who can assist these RFIs to fulfill their requirements? And what are the consequences for the failure to fulfill the requirement? The penalties vary. And what about those third parties? And what will the administrative penalties be like in lieu of prosecution? We need a list of such Q&A. That list will give the industry a clearer picture of the bill. I recommend such a list. I hope the information can be provided. So, since that's what members feel, we will stick to the 12:45 conclusion time, and we will save the remainder of the discussion for the next meeting. The Secretariat will let you know the date of the next meeting. So I adjourn the meeting here. Thank you.